In India, traditional investment classes that carried minimum risk have been the preferred investment route for the older generations, while the younger generation of investors are gradually shifting away from those to more profitable pastures. Many still struggle to keep doubts in check when it comes to non traditional investments or those that feature a certain element of risk. Now, the narrative around mutual fund investments and how they are managed can appear too complicated for new investors. One such example where myths and misinformed perceptions have been dominant is in the arena of passive investing and passive funds. Yes, the buzz around passive funds has been getting stronger as more investors jump onto the bandwagon, and stats back that trend. A report by BCG on the global asset mix of mutual funds pegged the AUM of passive funds at $22 trillion dollars in 2020. Now, this figure is projected to rise to $34 trillion dollars in 2025. But even as the tide turns in favor of passive funds around the world, with many investors embarking on the path of passive investing, there is still a considerable section that remains apprehensive about it, and therefore it is important to shine a spotlight on this subject. Now, in an effort to enhance the conversations around passive investing, Hindustan Times, in association with Aditya Birla Sun Life Mutual Fund, brings to you this virtual discussion. I'm your host Gautam Srinivasan, and joining me are Lovaii Navlakhi, MD and CEO of International Money Matters Private Limited, and Abhishek Singhal, Head of Passives and Products at Aditya Birla Sun Life AMC Limited. Gentlemen, thank you so much for joining us on this talk and looking forward to learning more about passive investing through your insights. So, Abhishek, let's start with you with some clarity on the definition of passive investment products, considering the funds universe has expanded dramatically and first-time investors might wonder where exactly to start.
Good afternoon, everyone. Gautam, it's indeed a new space. It's a fast picking up space, very, very vibrant. And if you go by the number of funds which are being filed, launched almost every month by all the big fund houses, small fund houses, you'd be amazed. 75 to 80% of all new funds are passive today. Yes, passives, manifest itself in different ways. There are ETFs, there are index funds, there are fund of funds. Passive essentially is anything where you don't have active, where you don't have any sort of interventions on a regular basis. These are more rule based, very transparent, low cost products. And hence, for investors such, as you highlighted, the new investors who don't want too much of complications in their portfolios, passives offers a wonderful opportunity to participate in market the way they want. If their risk appetite is high, if they want to take higher, if they want to go for higher returns and are okay with higher risk, you have products which are designed for that approach, like fund of funds, which are asset allocation approach. If you want products which are more indexed, you don't want any sort of confusion. You just simply want to buy Nifty and sit tight. You have a Nifty 50 ETF, you have an index fund, you have all sorts of solutions which are available. It's a very, very versatile asset class. And I think, as you rightly pointed out, the BCG report for global markets, in a short while, it's going to hold true for India as well.
In a sense, it's take it easy policy, but it's only recently that India has joined this passive investing bandwagon, Abhishek, as opposed to, say, Western countries where passive investing practices have attained sophistication. What are your thoughts on that?
You're right. So India, looking at the numbers, you can say that India is a recent participant to the passive bandwagon, but actually it's not so true. For example, the index fund that we manage, we launched it in 2002. One might say that we may not have done justice to that fund or to that category, but then India is known to be a leapfrog nation. Our growth in passives is phenomenal as an industry. Now, in 2015, when EPFO said that they will start investing in ETFs, this was less than 1% of total AUM. As we speak, passives constitutes about 12% of total AUM in the mutual fund industry. We all know that the mutual fund industry is growing at a massive 23-24% per annum over the last maybe 5, 6, 10 years. Within that, if our AUM has grown like this, you can well estimate the growth that passives is seeing. Of course, the key factors driving this growth are pretty similar to the rest of the world: lower expenses, large scale underperformance of active funds during the 2018 to 20 period, as well as the government and the regulator support. But these new products which are getting launched, largely because of digitalization of industry, I think passives are going to grow much faster. See the way fintechs and advisors like Lovaii here are growing, and because of this growth itself, you are actually going to see much faster prominence of passives coming in active investor portfolios as well. Just a small data point: in 2019, there were a total of about 141 funds filed with the regulator for launches, out of which passives constituted only about 27%. In 2021, there have been 200 filings with the regulator so far, out of which 77% have been passives.
All right. 12% of AUMs and so many filings, we've just scratched the surface. But to expand on the point that you bring about benefits, let me bring in Lovaii. Lovaii, considering many investors in India may not be privy to the realm of passive investing, what would you tell them regarding the benefits of passive investing?
So, Gautam, I think that passive investing sort of takes the fun out of and the excitement out of investing in equity in a manner. And people are used to, reading headlines about how many lakh crores the market gained or lost every day.
Or watching shows about it.
Yeah, or watching shows about it, absolutely. So I think in a way it sort of simplifies, and makes it much easier for people to understand where they are investing. I think one of the reasons why there has been this growth in passives in the recent times, I think we have to give some credit to SEBI, which is the recategorization of mutual funds. I think that happened in 17 or 18, if I remember right. And at that stage, they said, oh, we are going to define what is large cap. And we are going to define what is mid cap in terms of universe. So now every fund manager has the same 100 stocks to choose when he is investing in a large cap fund. The chance that, you might pick something over something else and, show great outperformance starts to sort of go down. And the other point that Abhishek made about passives being lower cost then starts coming to the fore, saying if I have to pay an extra fee to a fund manager to show, their active performance, how it has done well, but the chance of doing that is much lower, then why should I pay that fee? I'd rather go to passive. So I think it allows investors to participate in the market without trying to figure out, which stock I should bet my money on. I mean, I'll just take one simple example, take the Nifty 50. And over the last, say, 5 years, it's possibly doubled in value. But there are some stocks, and there are some stocks which are really good, real solid names. Take an example of HDFC Bank. It's gone up only 25% in the last 5 years. So if I had decided, oh, I will put all my money in HDFC Bank, I would have underperformed the index substantially. Same thing is true with many other stocks. So I think it allows investors to participate without figuring out, okay, which stock should I throw my dart at and try and make a lot of money.
Well, if that's the case, I'm sure some investors would be wondering, why didn't we do this before? Because if active investing, it requires a considerable level of know-how of market dynamics, and that seems daunting. Why not go with passive investing where you kind of leave it to the market to grow? What's your thought on this, Abhishek? Why was this not popular earlier? And considering it's such a simple and straightforward option for many investors, especially new investors.
The investment universe was kind of straitjacketed. Top 100 stocks being available for large cap, the next 150 stocks being called mid caps, and the rest of the stocks being called everything being small cap. Now, 100 crore, 1,000 crore market cap company at one point in time was defined as a mid cap company, in the 2000 to 2010 era. But today, that company is actually a small cap. Sometimes even some fund houses go as much as saying it's actually a tiny cap. It's not even a small cap. So The definitions are very different, and the opportunity to generate that alpha actually has changed. The inefficiencies of market have seemingly disappeared, and because of this, last maybe 15 years, 2000 to 2015 period, creating that alpha was much simpler.
Hmm.
Clearly, passes were not so visible. As I said, our index fund was launched in 2002, and yet beating that same index was so easy. Post this recategorization, I think the investors are becoming more cost conscious, they're more demanding. And I think, as Mr. Lovaii also mentioned, the awareness is significantly higher. Today, the media is talking more and more about passes every passing day. Earlier, the fund was, so and so fund manager bought into so and so stock, and the stocks would typically move. Active management was generating that buzz, it was generating that alpha. With all that evaporating, I think investors are clearly more focused on the passive opportunity.
Absolutely.
Secondly, I might want to also add that even distribution, which has really expanded the market, the mutual fund business so much, even in the hinterland, the B30 or the smaller towns, grade B, grade C towns, which are participating in the markets today through mutual funds, want to understand more and more. And frankly, active funds seemingly are a black box for them. Decision making is still somewhat hazy. There is opportunity for creating alpha in mid cap, small cap, diversified funds. Nobody can deny that. But the fact is that investors don't find it easy to understand.
Hmm.
Index being available every day on the exchange or on the websites, it's easy to know what is there in the portfolio, what are they buying every day. And then
Hmm.
ETS, for instance, just like stocks, you can buy it, you can sell it, you can do a same day buy and sell. So that's made life easier for investors as
Absolutely. That recategorization, I think it played a big part in making sure that, funds don't take the shortcuts by padding up their offerings with mid and small caps and showing alpha and then saying, hey, look, we are better. But they also go through ebbs and flows, Lovaii. I mean, in the sense that, active funds, well, they see periods of underperformance, but suddenly they shoot up and then they can showcase that as sort of a signal that, hey, look, we are better. In a sense, is passive investing the right way for folks who are looking for long term investing options? It's steady.
See, I think that I feel that what had happened in the past, the fund managers were allowed to choose what they wanted to invest in. So even if they were running a large cap fund, but they found, oh, mid caps are doing well, they could go there and get the extra return. So I think active was playing a important role in the past, and it's not to deny the expertise of fund managers. The other, I think, important factor that India went through and has gone through, I think, is that there were many sectors which would play a dominant part in the economy, but they were not listed. So if you go back, say, 2 decades, there was nothing in telecom. There was nothing in possibly oil and gas. Automobile sector was, very limited. So I remember when Maruti issue came, it was such a big thing in, I think it was 2004, 2003, 2004. And that sort of propelled the market saying, oh, now there's an opportunity for, some of this public sector being sort of opened up and being invested in. So I think that there was a role for active fund managers in the large cap space to do that.
Hmm.
Now, as soon as you move away from from large cap and go into not even mid cap, but let's say small cap, now that universe of stocks is very, very large. So if I, consider myself an expert, then I can pick and choose which out of those small cap stocks will really do well and create a portfolio and get a much higher return than what that index might give me. But at the same time, if I choose badly, then I will do much, much worse than that index. So that index and therefore the passive investing becomes a sort of safety, safe ground or
Hmm.
a safety net in which I say, okay, I don't want to go too far away from what the overall market is, earning. I'll stay in around that part. It's okay if I don't make 10% more than that index. If I do 0.5%, 1%, or even if I make the index returns, I'm happy. Then that's a good way. I think it's a very good way for new investors to get in
Hmm.
instead of trying to buy a stock and they keep watching the stock and the palpitations up and down every day with how that stock is moving. So even if you look at markets days then when they are you will see the index is down by 1% or it's up by 2%. There will be some stocks which are up 10% or down 10% or even more, depending on whether they are in the derivative segment or not. So you know that the volatility is much, much higher.
Hmm.
The passive funds will ensure lower volatility. It doesn't mean that they are safer and they will always make money, because if the index goes down, they will also fall. But it will be aligned with that. You're not sitting and watching and saying, oh, market's down 10%, my portfolio is 25% down. Okay, my portfolio is also down 9 or 11%. And yeah, I mean, I feel bad about it, but uh, I don't feel
There's
worse than my
safety
neighbor.
in that logic that, at the end of the day,
Yeah.
if the market is down, so is my portfolio. At least it's not down by 25% while the market is down 10%.
Yeah, yeah.
Fair point.
Of course, I think that doesn't hold true when the market goes up because you want to make that 25%. So,
That's where the true test of an investor comes in. But keeping that in context, Lovaii, how can the addition of passive investments add value to an investor's portfolio? Because when we talk about financial goals, and that's where a good investment strategy comes from, when it's synced to goals. So, what kind of time frame and goals are passive investing suited for, in your opinion?
I think there are two possibly different things in my mind. One is you're looking at goals from point of view of time. That A goal is coming up in 3 months, B goal is coming up in 4 years, C goal is coming up 2 decades later. So the simple sort of thought process is the longer the period for the goal to come up is where I can take risk. If it is shorter, I cannot take risk. So first and foremost, I eliminate trying to take risk if a goal is coming up in the next, say, 6 months, 9-month period in normal times. If you think of the pandemic, post-pandemic, etc., being abnormal times, I will say 12 to 18 months. I want to be safe because I don't know what sort of headwinds could come at any point in time. So I just want to be safe. Next 12 to 18 months, money is kept aside safely. Now, once I go beyond that, of course, I can't put all my money or everything is beyond, say, 3 years. Now, the rest all goes into equity. Then you start looking at your risk profile and your asset allocation and say, overall, my asset allocation cannot be, say, more than 60% in equity or 30% in equity, depending on my risk profile. So that's the second part. Now, once I've got that equity piece in place, that's when I start now distributing that money in equity. For conservative investors, I would say a very large portion will tend to go towards large cap and blue chip because logically mid cap, small cap are more volatile. They take much longer. There are much longer cycles of movement. Drawdowns and the negatives are much larger when they happen. So you tend to be more in large cap for a conservative investor. Once you start becoming, from conservative, you're moderate, you're aggressive, you can start saying, okay, for me, the large cap component is 60% of my equity. Now I can do 30% in mid cap and 10% in small cap. Now, once I do that, then I can say, okay, large cap, let me put 75% of my money in passive because I can see that there is no great benefit of going to an active fund manager. I can even go to 100% there. And then similarly, then you take mid cap and say, okay, let me put some portion, 30-40% in passive. The rest can be active in small cap. I can, if I've done a very good job of selecting, I'm feeling comfortable, then I can go active. If not, again, I can go passive. And I think one important piece that I missed in all of this is that it's not just investing in India, you're looking at international. And once you go international, the risks of choosing wrong go much higher. Uh,
Hmm.
I know people will look at and say, okay, look, this is the return Amazon has given or Google has given in the last year or 2 years. But there have been days where the minus on those stocks is much, much larger than the index. So you may be much better off choosing, say, S&P 500 or Nasdaq, or even a global world index rather than trying to be in one particular country. So I think there also again a lot of passive plays a big role there as well.
All right, that's our note to investors. If you're wondering how passive investing helps to put value in your portfolio, in a sense, it also simplifies it. But taking a point with Lovaii mentioned, and I'll ask this to Abhishek. Abhishek, what about the recency bias? Because if, say, I'm embarking on a journey or starting to embark on a journey on passive investing, and I see, the news reports coming in of, the markets falling down, I'll still wonder, do I need to take this route? What would you say to investors then, especially when it comes to this point of recency bias?
I think recency bias has been a problem for investors at all points in time. Whether your recent past has been for markets has been good or bad, you will always view the future with the color of the last maybe about 2 to 3 years of performance. Currently, of course, this correction looks like a God sent opportunity to get in, at least for people who've been sitting out for a while thinking about markets being very expensive. For those who have not been able to book profits, we'll see, oh, it's a long-term hold now. I have to wait out this correction. But I would say, as Mr. Lovaii also mentioned, that at any point in time, it's a question of asset allocation. And research shows that more than 90% of your portfolio returns, especially from a long-term perspective, come from asset allocation, the right asset allocation. So if you're starting now, for all investors tuned in, I think it's a good opportunity. First step that you do is evaluate how much time are you building your portfolio for. Anything that you are building for more than 3 years, you should be more equity biased than fixed income. And the good part is that today passives is not only about equity. Maybe we are discussing more and more about equities, but another point that I should mention is that passives today is actually growing faster in fixed income than even in equity. And as Mr. Lovaii also mentioned, international is a critical part of your overall asset allocation. India traditionally has had very high home bias. Less than 3% of our overall assets are in international markets. And they offer good value for people who have the stomach for it. Best way to go is an international index product, something like a Nasdaq or an S&P based or a world fund of funds sort of thing. So if you're looking at investing now, maybe 60-40 is a good ratio to go with for 60% domestic equities, maybe 30%, 10% could be international and gold. And all these can be achieved through index funds or fund of funds. The equity component could be based more in favor of large caps if you're a new investor. I would strongly recommend large caps and maybe a diversified fund to build as an anchor of your portfolio. But yeah, it's a good opportunity to get in now.
All right, taking forward the point that you've mentioned about the different types of passive investing strategies, looking at the profiles of investors, different profiles of investors, how can investors know, considering if they come from say diverse backgrounds, which is the right strategy for them? Well, your thoughts on this, Abhishek?
Very interesting question you asked, Gautam. The way we look at passives, we've got 3 different platforms: ETFs, index, and fund of funds. So there are essentially 3 kinds of investors. One who say that I know it all and I can do it all. So these are DIY guys. They need ETFs, exchange traded funds. They will even go to the extent of selling at 11 o'clock in the morning because markets were high then. And since then, markets have actually fallen off the cliff. So they'll probably look at covering their position in the same Nifty 50 ETF, buying it back and blocking an arbitrage. There could be index funds for investors who are index guys, passive guys, but they don't want to churn so much. They don't want to buy and sell every day. They don't want to trade. So they're essentially longer term players. They don't want complication. Buy into an index fund, sit tight. Index rebalancing will take care of everything for you. And there is a third category of people who need assistance. So I think fund of funds is a good category for them. You have asset allocation products there, which will give you access to equity, fixed income, international commodities like gold, etc. And the fund manager will do it for you. They will do the fund selection. They will do the ETF selection. They will do the active fund selection also for you. And there can be thematic fund of funds, there can be international fund of funds, where you can decide what your asset allocation is and the fund manager does the rest for you. So there are these three kinds of investors and three kinds of solutions available for you.
All right. I read somewhere, Lovaii, that, passive investing reduces decisions you make, since decisions could end up being sources of underperformance. What is your thoughts on that, considering we spoke earlier of how it simplifies the portfolio and the fact that decisions could be a source of underperformance? The more you make, the more chances are that, volatility plays its part in reducing the performance of your portfolio. What's your thought on this?
Yeah, I think it's also true mathematically, right? That if your chance of success, let's say you are a fantastic investor, and your chance of success is 90%, the second time you take a decision or take an action, it's now down to 81. The third time it's down to some 71 point something, and so on and so forth. So multiple transactions, unless you are 100% sure shot sort of investor, is definitely going to reduce, your returns. So I think that passive, in a way, removes, like I mentioned earlier, removes the excitement of the stock market. I mean, yes, you're watching the index and saying, okay, it's 17,000, 16,000 Nifty, is it going to go to 18,000? But the excitement of a particular stock and that large movement that you can see in some of the stocks goes away. Um, in a way, I feel that, you were speaking about recency bias. So I think in a way, it sort of stabilizes and brings in some discipline in terms of investing. I don't need to really worry about, um, what has happened in the more recent past or what has happened to a particular stock or a sector and so on and so forth. And I think the important thing is, of course, looking at my asset allocation, my time horizon. We spoke about investing in equity if you have a time horizon of more than 3 years. My take is that once I am investing in large cap, that 3 years is fine, 3 to 5 years is fine. But as soon as I'm putting money in mid cap, my time horizon has to shift to 5 to 7 years. If it's small cap, it has to go 7 to 10 years. I'm not saying you don't need to move anything out of that mid cap portfolio for 7 years, but you have to get in with the intention of being there and saying, okay, I will ride the volatility because that's when I'll make the most money, and there is data, etc., to prove this. So I think that's the important part. So the passive may allow for people to hold on to their investment even in volatile times. And that, as Abhishek mentioned, with 90% of my returns is going to be because of my asset allocation, then staying in that asset class is far more important than, being that ETF trader, 11 a.m., sell and buy at 2:30 p.m.
Well, as they say, time is money. But more importantly, when it comes to investing, you need to make sure that time is on your side. Well, when we talk of investment, how can the talk of tax implications be left behind? So, Abhishek, could you throw some light on the tax implications of passive investing? Do they generate superior post-tax results in the medium to long term?
Yeah, so it's an interesting aspect, and I think this is one of the myths about passives as well, that they do generate better post-tax returns. Frankly, I think passives and actives are pretty much, I mean, they're mutual funds after all. So they're pretty much on the same platform or same level as far as the taxability is concerned. The only advantage, I think, is with fund of funds, which give you a significant tax saving on the churn of the underlying portfolio. So as an investor, let's say if my asset allocation is 60-40, and I see that markets have dropped, it's a good time to sell out of fixed income, buy into equities. If I do it on my own account, even in passives or in actives, either which way, it requires me to book some bit of my returns on fixed income, which, if less than 3 years, could be a short term capital gain and hence chargeable to maximum marginal rate. As a fund of fund investor, if the fund manager is doing it for me, that tax cost is free for me. That's the alpha that can potentially get added to me as a post tax return. For me, is the units of the fund of fund that I'm holding. And at the end of my holding period, which potentially could be 3 years, 5 years, 10 years, whatever it is, I will just simply enjoy that that unit long-term capital return. So that's the only advantage or tax advantages product that we have. But apart from that, it's pretty much the same for equity-oriented passives as the active mutual funds on the equity side. For fixed income, again, the taxation is pretty much the same. Holding period of 3 year periods, beyond which it's LTCG, long-term capital gains. Apart from less than 3 years is short-term capital gains tax.
All right. Any other myths that you would like to dispel, Abhishek, especially when it comes to this debate between, say, passive investing and active investing when it comes to returns? Anything for the viewers to know about?
I think given all the fun stock selection, all the glamour about having a very high strike rate, multi-bagger stocks in the portfolio, usually investors or maybe even a lot of market analysts tend to believe that passive investing generates lower returns. There, frankly, is now data proof that passive investing has been a better way of investing. If you look at this PBAR, it over the last 10-year period shows that in the large cap space, roughly about 66% of the active funds, have underperformed benchmarks. Last 1 year to 5 year period, you look at any period, at least 82 to 86% of all large cap funds have underperformed index or a large cap index. Essentially means that passive fund, an index fund focused on, let's say, a Nifty, Next 50, or an ETF focused on these indexes, is your top decile fund for a 2 or 5 year period. Even in the diversified space, you have 50% or higher funds underperforming benchmarks. So this is one of the myths which is present about passives, and I think given more and more themes, more and more quantitative techniques coming in about cutting down on volatility, increasing or emphasizing more and more of alpha creation of stocks in the portfolios, I think you have some very interesting times ahead. Of course, markets are cyclical. There is space for both actives and passives. The last 3 years belong to passives very clearly because there was a very, very narrow breadth, and as Mr. Rohit also talked about, post categorization, the space for outperformance or stock selection was pretty limited. But as we move forward, as newer opportunities come to market, it will be, I think, interesting times for active funds as well to generate that some bit of alpha. You see the Zomato listing, you see the RateGain listing, which is about to happen. There are lots and lots of these IPOs which generated massive return over the last maybe about 2 to 3 years. So you have, and with markets in a slightly momentum a bull sort of a phase, I think active funds could surprise. I would say that watch out for some newer ideas. There is some bit of convergence which is going to happen between actives and passives. There are going to be more semi-active sort of funds coming in, which are from an investor perspective passives, because there is no day-to-day activism, but there is an activism built into the index itself.
All right. Looks like we're achieving singularity when it comes to investment products. But tying up that thread on returns, Lovaii, measuring passive portfolio, say from the perspective of risk-adjusted return, average volatility, drawdowns, your thoughts?
So I think that, I would say probably a decade or so ago, whenever there would be an investor who returned from the US and then he came to India and we would tell him, let's go into active diversified equity fund. They said, no, I've read enough literature which says that that's a bad idea. I realized that one of the things that caused that was that the markets were very mature in the US. Returns in equity markets, if you got 8% was fantastic, 6% was the norm. And in that, you realize that, okay, the difference between the fund management charge between an active and passive was 1%. That's a lot of money to give away when you're only going to get 6% or 8%. And in those days, India was running at, 14, 15 was pretty much the norm. it was, very easy to tell investors or try to tell the investors that no, it's fine. You look at returns after your cost, and even that is worthwhile. I think now with awareness having spread, the markets being getting to be more mature, etc. Definitely, that's something that one needs to watch out is the cost differential between an active and passive. That becomes one factor. But having said that, I agree with Abhishek that I think there is space for both. I don't think this is a time, and I don't think there will be a time where you can say chuck away all the active and only be in passive. And you could be in passive, but then the whole game will move towards okay, which passive? Should I go to Nifty 50 or Next 50 or mid cap index or a small cap index, and or go to a sectoral fund? So you will always find that there are opportunities to make money. And as soon as I can tell everyone that as soon as you make two investments, not one, but two investments, there will always be one of those investments in last place. One is first place, but the other one is last place. And then you start looking and saying, why am I there? I should put everything in the first place. And I do it based on past returns. So I think that's one warning to investors that certainly not the right thing to do is look at the past returns. And I know we spoke of recency bias. It's unfortunate people tend to look in the rear view first before you invest. And investment is all about the future. Right? So it's you should actually cover your rear view mirror and not look at it at all. And say, if I had money today, where would I put the money? Not, oh, because my money in X particular sector or fund gave me 50% versus the other one which gave me 20. Now let me put the money in 50. I don't think that's the way to do investing. So asset allocation important, looking at your risk important. Certainly having your core or some of the fundamental large cap investing in passives again important. The rest, I think, is left to you and your advisor to suggest.
All right, you've given us a nice segue to conclude the conversation. Cover the rear view mirror and look to the future. So, Lovaii, Abhishek, let me ask of you your summary thoughts. How does the future of passive investing in India look, and how is it different from other countries? Lovaii, you could take this first, and then we'll conclude with Abhishek's views.
I think that passives across the world, have been growing, are prominent sort of part of the investing universe. And India is catching up really fast. So India will not be, 20 years or 30 years behind the US just because, that's the way the size of the market is sort of that much behind. It will catch up really quickly. So newer thoughts or newer sort of methods of investing is something that India will lap up very quickly because awareness is something that Indians really thrive on. And of course, with media and interviews like this, which spread awareness, certainly helps. So I think passives have got a big role to play, but I think the variety of passives is just going to increase multifold. And so don't get stuck with, oh, I will only go and put it into an index fund in India, and that's all the passive that I need to do. As Abhishek mentioned too, that there is a good amount of opportunities even on the debt side. But I think as we sort of Indians realize that it's good to have international investing, you will find a huge variety of passives sitting over there for you to partake in. So good luck in investing is what I would say.
All right, there are choices and there are opportunities, depends on your perspective. The last word from you, Abhishek, on the future of passive investing.
I could be seen as biased being a passives guy here, but I think the growth is going to be phenomenal. We are sitting at about 11 to 12% of AUM today in 2021 as we conclude the year. My guess is by 2025 we should be at 25% of total mutual fund AUM. It's a big jump, but I think this will probably happen even faster than I am imagining right now. Some of the big tailwinds are going to come from the digitalization growth of fintechs as adoption increases, as Mr. Lovaii talked about, awareness, and our consumer, our investor is information hungry. The new generation is born with mobile phones. I mean, I showed my daughter, a phone that the one that you used to, dial numbers on, and it used to do tring, tring and stuff. And she was like, "What year was this last?" So digitalization is going to drive, the spread of passives like crazy. That's one. Two, the newer asset classes which will get introduced, and I don't think we talked about international enough here. Mr. Lovaii was kind enough to, bring it in. But as investing internationally increases, and that trend is catching up pretty fast, our AUMs in international as an industry have gone from less than 1% maybe about 3 years ago to close to about 3% already. I think passive is the right way to proceed there. We are not at a stage where we can do stock selection or country selection as well. I think indexes is the right approach, and that will be an added tailwind. New ideas like quantitative techniques, smart beta, fixed income, they're absolutely going to blow this market away. So watch out for new ideas. All investors, I think they are in for some really, really good times. And I think fund managers are going to have a slightly difficult time going ahead.
In defense of the new, Abhishek, but you never know, maybe the balance could be achieved, as you mentioned, a singularity could be reached. And of course, knowledge is power, and that's what this talk is all about, to provide you with a learning exercise to know more about, the investing universe, and more importantly, the passive investing universe. But we have run out of time, and as I mentioned earlier, time should be on your side. But for now, let's conclude our talk around passive investing and understanding the nuances at play. For those of you who are embarking on an investment journey, we hope this conversation serves its purpose of getting you thinking about not just the present, but the future of your capital. I'd like to thank Abhishek and Lovaii for sharing their insights on the topic. And of course, thank you to our viewers for tuning in. This is Gautam Srinivasan signing off. Have a great day.